Are you keeping your share certificates in your vault? Then you are an owner and custodian of your Apple shares. Are you holding them in your investment account? Then actually you are not holding your Apple shares. You are an owner, but not a custodian of your shares. If you are holding them in your investment account, then your investment dealer is holding them for you. The investment dealer is a custodian of your shares or your asset. The current market systems are built around this pivotal role of custodians with book-based or paper-based systems. Custodians are key to protecting our securities or investment assets and providing trading and settlement services. Therefore, custodians are heavily regulated. However, we still experience the custodian risk. We experienced it with Robinhood during the COVID time. We recently experienced it with the Silicon Valley Bank. Sometimes we hear the news that money that was deposited years ago is gone from a bank's ledger. The risk or inefficiency does not stop here due to the book-based system. In the securities world, somebody has to track ownership of securities when they are traded. They are called transfer agents. Someone has to clear and settle securities transactions. They are called clearing agency. As there are multiple ledgers kept and maintained by these intermediaries, there should be an ultimate custodian of ledgers. In the banking world, the ultimate custodian is central bank. In the securities world, there are custodians in each country. This complexity creates risk. Somebody has to identify the risks and provide the details of how to mitigate those risks. They are regulators. There are securities market regulators. There are money market regulators. In some jurisdictions, they are one entity. In others, they are two different entities. The current market regulations are based on the book-based systems with multiple ledgers that are kept and managed by multiple intermediaries. To make a change for this complicated world, the blockchain technology provides self-custodial or non-custodial wallets connected to the distributed network. What does that mean? In the current world we live in, let's say you own and hold your shares in a form of share certificates. If you want to trade them, you need to deposit them in your investment account so that your investment dealer can hold your shares to trade through their market systems. With the blockchain technology, your share certificates are ledger entries in a distributed network. The ledgers are called tokens. You hold your tokens in your self-custodial wallet. You do not need to deposit your tokens in your investment dealer systems. While you are holding your tokens in your wallet or vault, you can still trade them with other wallets in the network. You do not need to rely on your custodian to trade your securities, removing the custodian risk. You directly buy and sell your securities or assets in a digital way between wallet and wallet. Also, we do not need transfer agents, clearing agencies, and custodians. The world of alternative investments does not have sophisticated systems like public equity and debt. Therefore, it carries various kinds of risks and inefficiencies. For example, it is hard to find buyers and sellers for trades as there are no integrated marketplaces. Transactions are done with the assistance of many professionals like brokers, lawyers, and accountants with layers of paperwork. So the cost of transactions is high in terms of money and time. Settlement of transactions carries higher risk as there is no platform to exchange the ownership of an asset and money at the same time. This is called counterparty risk with the blockchain technology. The ownership of alternative assets can be digitized and held in a self-custodial wallet. The digitized alternative assets can more easily find buyers and sellers in decentralized marketplaces in a digital way. It can remove the counterparty risk by allowing the atomic settlement or real-time settlement of buy and sell transactions. With blockchain technology, the counterparty risk is removed with wallet-to-wallet transactions with pre-clearance. The wallet's holdings, digital securities versus funds, can be ascertained at the moment of the atomic or real-time transaction. This kind of market infrastructure using blockchain technology immediately makes alternative investments more efficient. And in the long run, it will make public equity and debt markets more efficient and less risky with a simplified structure with fewer intermediaries. The public markets tried to employ blockchain technology for years, but the anticipated innovations with the new trials have been stalled for a while. The main reason for it has been that they wanted to use blockchain partially while keeping the current infrastructure intact without changing regulations. We need a new blockchain-based financial market infrastructure to see a full innovation with a new technology. Interestingly, this is why the alternative investment world gains immediate benefits from blockchain technology. In order to properly entertain the blockchain innovations, regulations should be established by analyzing the benefits and risks posed by the new market infrastructure, rather than focusing on the financial products on blockchain.